Hi, everybody. Thank you for joining us today. We're excited to have David Lerman and John Breyer joining us today. David is the Director of Education, and John is Director of Client Development, both at the CME Group. And David will be presenting trading crude oil and natural gas futures at the CME Group today. Before we get started with David's presentation, we would just like to talk about the CME Group and Tradovate, how they work together. So while today's webinar focuses mainly on crude oil and Nat Gas futures at the CME Group also offers a wide range of products that are available on Tradovate. We would encourage you to check out the CME Resource Center on the Tradovate website under the Knowledge tab. At the CME Resource Center, you can find heat maps, trading insights, and more. We also encourage you to visit the CME Group's website at cmegroup.com for a wealth of information on trading futures. Before we get started, let's go over the standard disclaimer. Brokerage services are provided by Tradovate. Tradovate is a member of the NFA and registered with the CFTC. This is not an offer or solicitation for brokerage services or other products or services in any jurisdiction where Tradovate is not authorized to do business, or such offer or solicitation would be contrary to local laws and regulations of that jurisdiction. Futures and options trading involves substantial risk of loss and is not suitable for all investors. Investors should understand the risk involved in trading and carefully consider whether such trading is suitable in light of their financial circumstances and resources. Past performance is not necessarily indicative of future results. All right, so after the presentation, we'll open up for questions and feel free to submit them in advance for consideration. And Dave and John will be happy to answer those, and we'll go over those at the end. All right. I'd like to now welcome David Lerman from the CME, and it's all yours, David. Thank you.
Thank you very much. So we have audio and we have the slides up.
Yep, everything looks good.
And slides are moving now.
Yep.
All right, good. Let me just get rid of this thing in the middle of the screen here and we'll go. All right, well, thank you very much. On behalf of the CME Group and myself, I want to thank Tradovate for hosting this webinar. And today we're going to talk about crude oil and natural gas futures and options. We have a couple of case studies. We have a lot of fundamental data to go over a little bit. We'll go over it quickly though. I have 63 slides or 62 slides, so we have a lot to cover, but I think we'll just skip a few slides along the way and we'll talk about some of the things that are most important to traders, okay? So we have the CME also has a disclaimer too. So just to remember, futures trading or swaps trading, they're not suitable for all investors. Each involves the risk of loss. So do your homework and do your homework. That's all I can tell you. All right, so the energy markets have been in transition ever since energy was discovered, 100 years ago in Pennsylvania, or whatever. But the last 20 or 30 years have been pretty interesting, particularly the last 1 year with COVID-19 and things going on with the Saudis, the Middle East, and Russia, and things like that. And there's a lot of transitional elements that are going on in the oil market. So the nice thing about North America, we've taken the lead. The United States has rushed to made it to the top of the production heap, which is pretty amazing given, well, you'll see a chart in a little bit here. North America, mainly the United States, and Russia and Saudi Arabia are the top three oil producers now. Who would have thunk that 5-10 years ago? WTI, West Texas Intermediate, which is what our crude oil contract is based off of, and liquefied natural gas are key things in this transition, because not only do we have a lot of crude oil now because of lots of production and technology, but we also have a lot of natural gas as a byproduct of that, and we can convert it to a liquefied form and send it over on tankers all over to the Middle East and Asia, or in Europe too. OPEC, Russia, US producers are all going crazy and trying to juggle what's happened with COVID-19 and the fallout from that. It was like a double-barrel shotgun aimed at the oil fields. It was pretty incredible. You had the demand falling off a cliff because of COVID and all the closures and the airlines and cars not driving as much. And then you had a price war, an overproduction by Russia and an overproduction by Saudi Arabia. So you flooded the market at exactly the time where you didn't need to flood the market. You need to do the opposite. But this is what happens sometimes. And this is why oil is always a wonderful trading opportunity for traders. Coal and fuel oil under threat from environmental concerns, with the new Biden administration now and, the Green New Deal, who knows what's going to happen. But Coal admittedly was dirty. It's not the cleanest of all our fuels, and fuel oil, same thing, but they are under threat, and they will probably continually be phased out over time in favor of natural gas, cleaner burning things, and of course, alternatives. So renewable energy, which brings us to the next bullet point, starting to be competitive. Solar, wind, all that stuff 20 years ago, totally non-competitive, but now becoming competitive because the cost per kilowatt hour has come down dramatically. Rise of Asia is reorienting all the trade routes around the world too. A lot of oil is making it over to China and to parts of Asia too, as that area grows just dramatically. China is now the second largest economy in the world, and it's pretty amazing what they've done in just the last 10, 20 years. We talked about this. COVID-19 brought demand destruction after the fallout. So yeah, it destroyed a lot of demand, and then we had a tremendous oversupply. Throw in the Suez Canal incident, which looks like it's partially resolved now. At least they got that stuck tanker and dredged it out, and it's moving. But there's a little backup of about 50 or 60 ships, and it's going to take a while. Plus, there's massive losses at like $400 billion a day, I think. So that's a huge amount. And that will, the oil markets will feel that for at least a couple of days, if not a couple of weeks. So here's one of the charts I wanted to refer to real quick. We're gonna have about 3, 4, 5 charts on some of the fundamentals here. Then we'll get into the price behavior, contract specs, and then some of the things that you can do in terms of trading spreads, trading options, and hopefully we'll have enough time to go through a good deal of the options part of this deck here. So you see from the 1920s to the 1970s, basically, United States production just went up pretty much every year. And then it peaked in 1970s, and then it dropped by half, which is why we were importing so much oil from the Middle East in the 70s and 80s and 90s. Remember the gas lines, remember the high oil prices, and oil prices at one time got to almost $5 a barrel in a lot of towns in the United States, especially San Francisco and Chicago. But then something interesting happened in 2010, all right? Technology hit the oil patch, and it used to be they'd sink a well, they drill a well, and that's it. If they hit oil, they hit oil. But now they can not only sink a well, a drill bit, and if they find oil, they can expand the amount of production coming out of that well because of something called horizontal drilling. So you can drill far, far away from the oil, but then you change the drill bit's direction, it goes into the oil, and you can get more oil from it. So instead of just getting the immediate part in the center of the oil well, you can go out on the circumference of the oil well and get more oil. That increased production dramatically. And then came something, Mitchell Energy came up with this, one of the research associates at Mitchell Energy, which was absorbed by some other company, but they came up with something called hydraulic fracking or hydraulic fracturing, where they stick water and sand under high pressure into shale rock formations, and it liberated vast amounts of oil and vast amounts of natural gas. And that happened in, around 2007, 2008. I mean, they were doing it before that, but it really started to ratchet up production in about 2010. And look at the production, US field production. It basically doubled and then went up to nearly 12 or 13 million barrels a day. And that's when the United States became the top oil producer. So right now, the United States is doing about 11 million, Russia's just under 11 million, and Saudi Arabia is just under Russia. So it's a really interesting race between Russia, Saudi Arabia, and the United States. Again, with the new Biden administration, we'll see what happens with crude production. Hopefully it doesn't go down too much, or we're going to see very high gas prices. And, cutting the Keystone pipeline certainly doesn't help our energy independence, which is one of the things that we have established in the last 10, 15 years. We have energy independence. We don't have to depend so much on a very unstable Middle Eastern situation. All right, couple things there. There's a lot of stuff on this chart. Again, we're going to make the charts available, and I believe they're being recording this. Tradovate's recording this, so you can reread it for the finer details. But I like to provide a lot of information so people have reference that they can go back to later on. But I call your attention down there to the second bullet point in red, the percentage declines. Refined products down 30%, gasoline down 40%. This is as of the April 2020. So this is dated, but it makes a great point. The demand destruction was incredible. Jet fuel down 63%. And I was reminded of this because, you know, I still fly a little bit for, you know, personal and, you know, for business. But you go past O'Hare Airport and you could see tons of planes parked on a tarmac that are just not going anywhere. Their engines are all covered up. So I think the airline industry, the hotel industry, and along with the restaurant industry just suffered dramatically. And you know, the demand fallout was incredible. Because the demand fall off and the extra production all around the world, U.S. producers kept producing. They had to pay their debt service, so they kept producing even though oil was plunging. And you could see storage just climbed dramatically after COVID-19 hit. It's just absolutely incredible. A record 19 million barrels of crude was added to storage the week ending April 10th, 2020. Again, a dated statistic, and that's going to come down dramatically as economies reopen and the U.S. economies reopen. So, but needed to show you how the oil markets respond pretty quickly to, you know, demand, supply and demand shift. And the COVID-19 was a gigantic shift. Weekly crude production, you know, we peaked at about just over 13 million barrels a day, and now we're around anywhere between 9.5 and 10.5, depending on which month you look at or which week. All right. The second bullet point there, you see the U.S. drilling rig count. It's currently 402 rigs. It's over 500 now. That I have an updated number. I believe it's over 500 rigs according to the Baker Hughes rig thing. It was over 2,000 rigs. It got near 2,500 at one point. So again, when you destroy the amount of demand that we had, there's no need to drill anymore. We're floating in oil, and, you know, negative oil prices let you know no one's going to drill for oil when it's trading 20 below, or excuse me, when it's trading at $20 a barrel and going negative for a day like it did. All right, a couple other crude dynamics. Just it reached a record high of 13.1 million. You can see in how it just dropped off. And then you can see exports. This is kind of what helped our situation until, again, COVID-19 came. But it was illegal to export crude oil to Asia or anywhere else out of the United States. And then in 2016, they changed the rules. And the United States can now export things, which is a good thing. It's nice to become an exporting country in some ways because we were importing way too much. And you could see we exported, you know, we went up 3-4 fold. And then, of course, COVID-19 came and demand dropped, exports dropped, and very interesting dynamic there. All right, so let's look at some of how this matters, how it's pertinent to WTI. And so there's the exports at the top, the chart at the top, the exports, and, you know, they came down after COVID. It came down pretty sharply. WTI futures, the open interest is still doing pretty good. It's pretty healthy at around 2.5 million. All right. I think we hit an open interest high of a 2-year high of 2.5 million in February of this year. So of 2021. Some of the volumes came down though, which makes sense. When oil is crashing, there's, you know, not a need to hedge it on the downside. There's not a lot of usage. There's not a lot of as much export, and therefore, hedging goes down, speculation goes down, although initially it was up pretty nicely. The other thing about WTI is it's becoming a truly global benchmark, which is good. There's on the chart on the left here, you can see the non-US hours average daily volume, and you can see the total average daily volume. And it's since 2014, it's gone from single digits all the way up to about 22%. So that's pretty amazing. The record was 24%. So basically a quarter of the volume comes from outside the North American time zone. So that comes from Europe and Asia, which is good. That makes sense. If we're exporting more oil, people are going to use the WTI, the crude oil futures at the Merck CME group, because we followed the WTI. We also have a Brent contract too, but a lot of people use Brent. But if you use Brent and you hedge using WTI, that's going to be a problem. So if you're importing WTI, you want to hedge using WTI because there's a spread, which we're going to talk about later, and that thing can get out of whack sometimes and create havoc for a big producer or a big user. Also with options, WTI options on the right-hand side, yes, a big drop-off in 2020 and 2021, but the open interest or the non-US hours has grown dramatically. So again, Asia and Europe have participated in our markets dramatically. So there's been a drop-off in volume, but the non-US hours has, you know, still steadily gone up. It's gone from basically 2% all the way up to about 16, 17%. WTI options, volume of electronic trading. You can see it's dipped a little bit, not dripped, it's dipped. And it's down around 72%. It was way up around 80, 85% at one point, up from 69% back in 2015. So again, a lot of electronic trading, which means a lot of overseas trading. The pits have, largely disappeared. About 95% of our volume overall at the exchange is electronic trading. But you can see the volumes come down since the pandemic, but it'll build back up. It should. There's just too much volatility and too much instability and irrational behavior in the oil markets for them to stay stable for very long. Henry Hub is our natural gas contract. It's officially titled the Henry Hub Natural Gas. We call it Natty Gas or natural gas, but the average daily volume you can see from 2011 to 2021, the track graph on the chart on the top has done very well. Despite COVID-19, the volumes have been higher. And again, the percent traded during non-US hours and all that stuff is up from, 4% all the way up to 10%. So natural gas also becoming a worldwide traded benchmark too. And you can see the average daily volume, the futures and open interest, still a pretty good uptrend. The open interest is stuck pretty well. It peaked at, 1.6 million, and it's now at about 1.2, 1.3 million. So that's pretty interesting. We still use a lot of natural gas. It wasn't that cold of a winter, but in Chicago, it certainly was in February. And as summer approaches and we use a lot of electricity, a lot of power plants now have been coal power plants have been shut down or converted to natural gas power plants. So it'd be very interesting to see what happens. And of course, LNG, liquefied natural gas, that's another thing that we export to, and the world needs natural gas, particularly Europe and Germany and those areas. They get a lot of it from the Soviet Union or Russia, excuse me, but sometimes politics and geopolitics rears its ugly head, and they threaten to change the pipelines or jack up the price or whatever. Options on natural gas, open interest has been in a kind of a secular downtrend from 5 million to about 2.5 million. Again, it just has to do with the dynamic. The pandemic had something to do with that, but actually volumes have been coming up a little bit recently, but we should gain that volume back too. Part of it has to do with the dynamic of what's gone on. We found so much natural gas as a part of hydraulic fracturing that you'd get such an oversupply that it puts a pressure on prices and obviously puts a pressure on volumes too. All right, a little price history, and then we'll get into some other things pursuant to the contracts and trading them. So this is a 1 year ending yesterday. All right, you can see nice move off the bottom there from 30 all the way up to 65, 67. We're currently, I haven't looked at it in the last couple hours, we're trading around 61-ish or something like that. I think the oil market's sold off a little bit today, at least earlier in the day. So you can see good trading opportunities in the last year. We doubled. We've had some pretty sharp corrections along the way too. A lot of trading opportunities. That's the whole point here, to say that crude oil markets definitely, it's recovered since the pandemic very, very nicely. Still nowhere near its all-time high of about $145 a barrel, but you never know what can happen. You turn the economies on, China gets going, US gets going, Europe gets going, and you can get a lot of demand real quickly. There's no reason why crude oil couldn't go decidedly higher. We're not allowed to make predictions at the CME group, but nothing surprises me these days. Here's a 20-year price history. You can see back in 2000, we went from basically $20 a barrel up to 145. Then we went from 145 back down to around 30, 35, and then we went back up to 110. So we went up 5-6-fold, dropped by 80%, then doubled or tripled, then came down again from $105 a barrel all the way down to $20 a barrel in 2016. That's when the rig count really started to drop. We were just producing so much oil that we couldn't help it, and prices slid. And then, of course, the pandemic came, and prices really came down and went negative a little bit by about $25, $30 a barrel. So no one can complain that there aren't trading opportunities in crude oil. This chart says it all. In just the last 18 to 20 years, we've had 1, 2, 3, 4, or 5 doublings or triplings. And you remember from the short-term chart too, you can see there's really good moves. It trades well. Because it's come down dramatically in price, the notional value of the contract is a lot smaller. And we also have a mini crude too, so that's half the size. So traders should really, you might not want to trade crude oil. You might not like the way it trades or whatever, but you should take a look at it because it moves, it's liquid, and the math behind it is easy. It's not like treasuries where you're dealing in 30 seconds or half of 30 seconds. You're dealing in penny increments, so it works well. Natural gas, amazing. Again, this is what happens when a hydraulic fracturing comes in or fracking. Gasoline, Nat Gas was in double digits, $12, $14 per million BTU or million BTU, I believe is the unit on that. British thermal units, that's how we heat our homes by BTUs, and you look at your gas bill, it's probably BTUs used. And that's how natural gas is priced these days. And you can see the long march down from 14 just in 2009, 2010, fracking and production really did well. Plus, what else happened in 2008 and 2009? We had a financial crisis. That dropped the demand for a whole bunch of things. So as a result, we're down around 250, 260 now. Again, tremendous trading opportunities in natural gas. Going forward, going backward. Again, the energy markets always provide some kind of opportunity. All right, so here are the contract specs and highlights. And you can see, I match them side by side, crude oil and the E-mini crude oil. The ticker's CL for crude oil. For the E-mini crude, it is QM. And one is 1,000 barrels and the other is 500 barrels. So it's really good. So the initial margin requirement is 3,800. Now this is subject to change, okay? Subject to change. Margins have been changing a lot lately, and it depends on the delivery month too. The near terms are trading at a little bit higher than the more deferred contracts because the near terms have been much more volatile. Just look at when oil went negative. Not every contract went negative. The near term ones did, but not the deferred ones, or they didn't go as negative. So $3,800 per contract for the margin for something held overnight. The notional value is $62,000, which is not that big. You compare it with other things. The standard pit traded S&P 500 is almost $1 million. The E-mini S&P 500 is about $190,000. Bitcoin's about $300,000. So crude oil is very manageable. The minimum price fluctuation is 0.01 or a penny, and that equals $10. So we go from 62 to 6201, 6203. Very simple trading, very easy to follow. And it moves too. It's very, very volatile. You'll see when we get to the options part how volatile crude oil has gotten. The E-mini is a 500 barrel crude oil contract. Obviously, the margins are going to be about half as much, and the notional value is about half as much too. So 31,000 is a pretty low value there. The tick size is a little bit different though. Instead of being a penny, it's 0.025. So that equals $12.50. And the contract months are listed there. We're not going to get into that detail because speculators and traders, active traders, tend to deal with the near-term contracts and not anything too far out. Trading hours are just like pretty much everything else at the CME Group. We start at 5 o'clock p.m. on Sunday, Chicago time, and we keep on going till 4 o'clock on Friday. We have a 60-minute trading hall at around 4 o'clock Chicago time for system maintenance, uploading and downloading of orders and things like that. So here, how does it look? This is a screen capture from CME Direct from a couple of days ago. CME Direct is the CME's front end, and it captures a whole bunch of data. It also lets people trade, but it used to be free. It's no longer free, but I want to show the liquidity. I want to show the top of the order book and just, how it trades, how it lays out. So you can see in the middle of the screen there, a long, big red rectangle. And that encircles the April 21st WTI future, which I believe is expired. It's gone off the board. The April contract expires in March, I believe. You can see in the middle there the bid and the offer. It's 60.85 bid, 60.86 offer. So it's 85, 86 bid offer. 12 contracts on the bid side, 11 contracts on the offer. Now, this doesn't show the entire depth of book. There's many, many bids below that 60.85. At 60.84, there'll be bids. At 60.83, there'll be bids. Same thing at 60.83, 82, 81. It's pretty deep market. For a commodity market, it's pretty deep. Yes, it's not as deep as Eurodollar futures or Treasury futures, but it's a commodity market and it's very volatile. So it's depth of order book is going to be a little different in complexion. So it's 85, 86, 12 by 11. You can see the last 60.86, but you could see all those markets down there. They're 1 or 2 tick markets for the most part. If you go all the way to the October 2021 contract, it's a 3 tick market, but it's very, very liquid. You can get in and out. 1 lot's no problem. 5, 10 lots, 20 lots, usually no problem at all. And if you want to do size, you can do size. You just got to finesse it a little bit. All right. And this is just a screen capture. A couple moments later, it could have been 50 by 50 or 100 by 100 or 1 by 1. It changes all the time. All right. But I just want to show you how the prices look on one particular front end system. All right. Nat Gas, same thing, pretty liquid. I don't have a rectangle around it, but the May 2021 contract, the bid offer is 2.881, 2.882. So it's 81.82, 16 by 3. The June is a little bit more liquid. It's 26 by 28, 2 tick market, 19 by 15. And generally 1, 2 tick markets again as a screen capture. It could be less top of order book structure, or it could be much, much greater. It just depends on what time of day, and I took them randomly. All right. Crude options, same thing, pretty good top of book and liquidity. You can see there's a 61 call, and you can see the 61 calls and puts. And you can see on the left-hand side of the screen, again, in a red rectangle, 168 bid, 171 offered, 87 by 70. So the market makers are doing a good job, and we have a lot of participants in the market. So it's a good market, 87 by 70. It's a 3 tick market on options. That's very tradable. The puts are 192, 195, 61 by 10. So again, you can call up CME. There's a lot of quote screens and quote montages that you can call up in futures. Tradovate has a system that you can call all these up to. This is just a front end system that's handy for me to use and very visible for presentation. So. All right, so let's look at a quick trade here, and we'll compare 2 trades, one done with crude oil, the regular contract, and one done with the mini contract, the QM contract. So both traders go long an April contract at 59.87. All right, so after day 1, there's no profit or loss. All right, they go long right at the close. T+1 the next day, it's trading at 60.50. So you've made 63 ticks. Doesn't matter if you made 0.63 points in the crude, the mini crude versus the standard size crude. It's the same number of dollars, 0.63, but since the multiplier is 1/2 on the mini, you only make $315 versus $630. T+2, another day passes, you're at 61.02. We made $1.15 a barrel. Again, because you have a half a size contract, you only make $575 in the mini. You make $11.15 in the large standard size crude. 3 days later at 60.93, you're up $1.06. So $1.06 is 1,060 in the standard contract. It's 530 in the mini. So at the end of day 3, the trader offsets at 60.93. Total P&L 1,060 versus 530. So the margin half, the profit half. The risk reward trade-off, more risk, more reward. With the mini, it's less risk, less reward in general. So those that are, should we say, less well capitalized, might want to, if you're considering trading energies or trading, crude oil, the mini might be for you. The mini, the volume has skyrocketed in the last year or two, obviously because of COVID and obviously because people like mini contracts. The micro and the mini contracts have been gigantic hits here at the CME Group, and we're very happy about that. And we're very happy for firms like Tradovate that are promoting them. So you can see, there's a lot to offer here and a lot of homework to do too. All right. So just, like I said, do your homework, and, attending seminars like this is certainly fits the bill of doing your homework. All right. Little breath of fresh air here. Drink of water. Now I'm on autopilot for the next half hour. So here's crude oil, WTI, versus the major energy ETFs. By the way, I forget to mention, the average daily volume for the mini crude is about 27 to 35,000 contracts a day. Sometimes it blows the doors off things and does a lot more. Sometimes it does a little bit less. But 27,000 average daily volume, you can get stuff done, not too much of a problem. But what this chart here does is it compares crude oil futures with the various energy ETFs. The very biggest and most famous one is the Energy Sector ETF XLE and the US Oil Fund. Those are two very, very commonly traded, actively traded ETFs. The US Oil Fund actually uses futures contracts and swaps. The Energy Sector ETF trades, it's like 50% in 4 oil stocks like Chevron, ExxonMobil, and a couple others. But it's got 200 stocks in it total. But what I call your attention to is the average daily dollar volume, and it's in red there across the chart. And you can see crude oil futures is 33.5 billion. And this is what price is way down from what their average has been over the last 3 to 5 years. The energy sector ETF does about 1.15 billion a day. The US oil does about 153 million, so it's 0.153 billion. The AMLP ETF, that's the Master Limited Partnership Index ETF, does 82 million, and the Vanguard does 51 million. So if you add up the 4 major ETFs, they don't come anywhere near crude oil futures in terms of average daily dollar volume, which just goes to show this, the ETFs, those sector ETFs and those oil ETFs are very good. They trade a lot, but the large amount of money and the large producers and large users and large traders, hedge funds, arbitrageurs, pension funds, you could see where their footprint is 33 billion a day. They're like 25 to 30 times greater than the other 4 ETFs put together in average daily dollar volume. So it behooves people to, go where the money flows, go where the liquidity is. And I think this is a great graphic to show that. The next one is an interesting case study. I got a phone call from a friend of mine back in like 2014, 2015. Crude oil was trading right around one of its major multi-year highs at 115. Remember, the ultimate high was 145 and then dropped down dramatically and then went up to 115. And I got this phone call when it was literally right at the top from a friend of mine who a CFA charter holder in Vancouver, British Columbia, and says, tell me the best way to play a major secular bear market in crude oil. And I haven't talked to her much since then, but what a trade. And I told her about the various ways, using swaps, using puts, using WTI, doing it with ExxonMobil, doing it with the ETF. So just for the heck of it, I tracked the trade from top to bottom. Now, this assumes you sold at the top, which if she acted on this, she called me the day of the top, which is unheard of almost. I've been in the business 33 years and I've never seen anyone call a top precisely. I mean, I've called a top by buying sometimes. I'm a great contrarian indicator in my trading, but I think we all do that sometimes. But what happened is we went from 115 to 29. So just for the heck of it, I picked, selling at the top, covering at the bottom at 29. And how would you have done on all the various ways you could have gotten into the energy markets? Well, we won't go over this whole chart. You did very well. The trade did very well in almost anything. If you did the ETF, you made wild profits. If you did the Schlumberger, you did great profits. ExxonMobil, you did good profits, but not nearly as good as anything else. People are always asking me or calling me or emailing me, Dave, what's the best way to play energy? You could do it with the ETF. You can do it with ExxonMobil and Schlumberger. The problem is they're large integrated oil companies or drilling companies, and they don't always move point for point with crude oil. I've seen crude oil go up $1 a barrel and ExxonMobil go down. I've seen, crude oil go up $10 in a couple of, days or weeks, and Schlumberger stand still. Schlumberger is in a, major secular bear market from 110 all the way down to 27. I know this because I used to own Schlumberger, no longer, but took some big losses in it. Enough of the personal stuff here, but I like to share bad trades too, because you learn from your bad trades more than you do from your good trades. But you can see the price decline in WTI was 74.7. If you want to play energies, if you want to take advantage of opportunities in energies, that's the way to do it. So the profit on the trade was 86,000. If you did it via ExxonMobil and called it, did it from 104 to 70, you did good. You had to put up a lot more margin though. The margin at the time in WTI crude was $4,500. To put up the margin on the equivalent notional value contract, $115,000 worth of ExxonMobil, you have to put up $57,500. That's a lot. It's a lot of money. You made $37,000, which is excellent. Schlumberger, you made 56,000. Select Energy Sector, you made 57,000. So you did well, but you did more well. You did better with WTI. Now you could call this data mining. There are times where you could have done this, and you know, if I looked at it from the last year with oil going from $30 to $60 a barrel, and it's very interesting what happened. Everything was basically a tie. So there are times when stocks will outperform because Exxon does pay a dividend, but crude oil doesn't pay dividend. But the dividend doesn't mean much if the stock loses half of its value or whatever, or 35% of its value or whatever. So anyways, you did better with crude futures. You have to, you know, test things out over time, but this is one test, you know, and I got that phone call, so I put it up as a case study. But you get around the clock trading. You don't necessarily get that with stocks unless you're very well wired, and liquidity overnight's not so good. Our liquidity in crude oil overnight is good. Spread efficiencies, yes. You can do spreading in WTI versus Brent or other contracts. You can't do that in ExxonMobil. What are you going to spread it against, you know? Dividends, you're at a disadvantage. Crude oil futures do not pay dividend. ExxonMobil's yielding about 6%. Schlumberger cut their dividend. They're yielding around 3%, I think. The energy ETF yields about 4.5%. So that's the only advantage they have, is they pay a dividend. All right, let's look. All right, so let's look at some of the crude oil benchmarks. We have WTI and we have Brent. WTI is West Texas Intermediate. That's what our crude oil futures contract goes off of, all right? Versus Brent. Brent is the North Sea oil. It's in the North Sea. That's where they get it from. It's a worldwide benchmark too, used primarily in Asia and parts of Europe. WTI is used in North America, Latin America, parts of Latin America, and parts of Europe. So when West Texas Intermediate and Brent generally move in the same direction, but they can sometimes move in separate directions, or one moves more than the other depending on supply and demand. So when WTI and Brent diverge too much, opportunity arises. So a few years back, Brent traded a gigantic premium to WTI. So as a spread trader, and again, it behooves you to learn about spreads. They're very good trades. They reduce, in general, they can reduce risk because you're simultaneously long and short. But not always. I've seen some people do July, November soybean spreads and get killed sometimes because one side went limit up, the other side went limit down, which is rare, but it's an old crop, new crop spread, so it can happen. So what's the recognized spread ratio for this? What's the margin offset? And what's the total margin required to implement? It's a very simple strategy. With crude oil, that's a nice thing. The math works out very easily. Let's look at the charts first. This is the WTI, Brent WTI. This takes Brent, subtracts WTI, and you can see over the last, since July of 2020, it's vacillated between 4 and basically 0. Back at the pandemic lows, the spread completely collapsed, which made sense because everything collapsed. But if you look at long term, you can go all the way back to 2017. You know, it was as high as, $12, and then it shot up to 40 during when WTI went to negative. So that's really messing up my scale there. But I have the chart on the right for precisely that reason. You go all the way back to 2010. The thing traded, the spread was all the way up at 28, and it slowly made its way down to 0 over time, and now it stands at around 3, I believe. So Brent's trading at a 3-point premium to WTI. So what can you do with this information? You could trade on it. So you can, if you think WTI is going to outperform Brent, you get long WTI and short Brent. If you think Brent is going to outperform WTI, you get long Brent and short WTI. So the clearinghouse, when you do spreads, they recognize certain ratios. Certain ratios would be 2 to 1. Some would be 5 to 4. With crude WTI versus Brent, it's a 1-to-1 ratio, which makes sense because they trade so closely and correlate pretty well. So the clearinghouse recognizes a 1-to-1 ratio of WTI to Brent for this spread to qualify for margin offsets. Now, you could do it in any ratio you want, but to get the margin offset, the really good margin rate, it's a discount actually, it's a nice discount. You have to do it 1-to-1. Otherwise, you're going to pay, you'll get margin offsets on the 1-to-1, and anything beyond the 1-to-1, you will pay gross margin, regular margins. And that increases your cost of trading. So the margin for one WTI crude, 4,500. The margin for one Brent at NYMEX is 3,600. All right. This is assuming you do the trades both at the NYMEX. Brent trades at the ICE exchange as well. The combined margin is $8,100. The margin credit is 77%. So you get a 77% discount. So 8,100, 77% discount, you only have to pay $2,100. All right. Now, I put WTI, the margin's 4,500 here. In another slide, I think you'll see the margin at 3,800. That's how volatile crude oil can be once. Sometimes it takes a week or two to make these slides. And the margins, if they go up enough, when I make a slide, I go to the margins on that particular day. That's why I always say margins are as of March 2nd, 2021 and subject to change. These are using the April contracts. They would be different for more deferred contracts. So you got to watch the contract that I'm using, and you got to watch for margins changing. All right. So the margin's $2,100, basically, just over $2,100. And if in the past, when WTI was at a $28 discount to Brent, it was because we were just creating so much WTI. We were flooding the market in the Cushing oil delivery terminal. Things were just completely out of hand. And you could have traded that. Are there opportunities going forward? I'm sure there are. Do I know them ahead of time? No. And if I did, I wouldn't be allowed to tell you anyways. Anyway, so that's one example. I gave you a couple examples, a simple trade and then a simple spread. And you can see here's a bunch of reports and factors that move the market. And you can see Energy Information Administration, domestic, GDP, natural gas inventory, API, OPEC meetings are very important. And you gotta, you learn this, do your homework, you got a learning curve, and you watch these things. If you've traded futures for any conceivable period of time or any period of time, you probably know about these things. But if you're new to the energy markets, you better learn what impacts the market the most. All right. A couple other things, the OPEC Watch tool. It's a great tool. It uses options to determine probabilities of possible outcomes. All right. So the three outcomes are increasing output, maintaining output cuts, and further output cuts. So will they be cutting? Will they be increasing? This will all have an impact on supply and demand and the price of oil. And the tool is pretty interesting. So here's how it looks. Here's what's right before the March 4th meeting. I put this up March 2nd. You could see maintain output cuts. In other words, maintain 74% chance. Increase output. Well, if you increase the output, that would, flood the market with more oil, 21% chance. And then more cuts. I don't think after what happened in the last year, they're going to cut 4.54%. So again, it uses options, which are based on probability anyways, and it tells you what the probability is of various things. Is it perfect? No. If it was perfect, everybody would be making huge amounts of money and using this thing. It's a probability type thing. Sometimes it's going to be right. Sometimes it's going to be wrong. And you can go back in history too. So you can look at various OPEC meetings going back many, many years, and you can see how things looked. And you can see here's what happened after the pandemic or during the pandemic. You could see further output cuts, increased output, and they were right. They forecasted increased input, and that's exactly what Saudi Arabia and Russia did. All right, so this the OPEC Watch tool, I suggest you give it a look. Even if you never use it to trade, it will make you a little wiser in terms of what's going on in the underlying markets. And it'll keep you in touch with the OPEC meetings, which you need to do, okay? All right, let's get it to options. All right, we're at the 43-minute mark, and we're not going to cover everything in options. I never expected to, but I want to give you a little taste for some things. So I'm going to skip a few slides. Their options volume, obviously in WTI, plunged after the pandemic, but it's coming back nicely. All right, I want to skip a couple of things. These are just expiration calendars. You can get them off our website, but I want to, whoops, going a little too far there. These are just expiration calendars that show when the weekly options, when the monthly options, and a quick strike calendar that gives you everything. It's very simple. You can get this off Quick Strike, which is on the CME Group website. It's a very good, it's an options analytical tool, but also has a lot of other information too, such as options expirations, as well as commitment of traders reports and options analytics. So it'll do your deltas and gammas and thetas and vegas. It'll do position analysis for you. It'll calculate skews and things like that. It's a really good tool. So there's the natural gas. And again, you can go through April and May and you can see all the weekly options expirations, all the, quarterly or monthly expirations, any expiration that we list that we'll have. So here's crude oil at the money implied volatility. It looks pathetic because the scale's all messed up because of what happened during the pandemic. Volatility made it up to 344%. If you normalize this, the real peak volatility is around 160. And the volatility and the scaling looks much, much better. But I kept it in there because, well, it's one hell of a conversation piece, that's for sure. But in general, crude oil, when it gets down to 25, 30, it's getting kind of low. When it gets above 75 towards 100, that's getting really, really high. But is there a better way to look at crude oil volatility for options traders? Yeah, and it's percentile rankings, which we've talked about ad infinitum for 2 or 3 years now. But they're a good tool and it helps to update them. So this is crude oil. The highest it's traded is really 178. The 344 was that aberration, but we had to put it in there due to negative oil pricing and just way hyper volatility, way too much volatility. Natural gas, it's high over the last 3 years is 125.07. Those are extremely high volatility levels. And you can see, so the 90th percentile in crude oil is 56.22. So if volatility is at 56, you're in the 90th percentile, which means 90% of the time volatility is lower. So if you're constantly buying high volatilities, it's not a great prescription for consistent profits. Probability says in the 90th percentile, volatility is going to be lower. And volatility goes lower. What does it do to options premiums? They go down. So the 50th percentile would be 32%. The 10th percentile would be 25%. Volatility as of March 2nd, 2021 is 38.60. All right. So it puts you in the 60th percentile. It's actually closer to the 75th percentile now. Crude oil is trading at around 45% volatility. So it's getting more expensive now. So be careful. This is a tool that you can use to try to, buy low, sell high. It pertains to volatility too. And the whole crux of the matter in volatility percentile rankings is to buy low volatility and sell higher volatility. At the very least, it'll weed out some bad trades. And I'm going to end this discussion and go to the Q&A in about a minute or two. But I want to show you what happens when you do the opposite. Instead of buying the low percentile rankings, you sell the low percentile rankings. So here's natural gas, implied volatility 3 years, case study. So that's why it looks dated. It's as of October 12th of 2020. And we're going to go back to 2018, case study. All right, natural gas options. You see the black circle there in the middle of 2018, July, August, September. Volatility went to the lowest historic level at that point, the lowest it had ever been in the 10 years of history of natural gas options. It made it to 19.5. It went below 20, which is, it really doesn't do very often. You can see it doesn't do it as a low. You do not want to be selling options volatility when it's that low. Statistically speaking, that is a very bad trade. All right. Actually, statistically speaking, it's a career ending trade. And I've had to tell this to lots of people over the last 30 years that that's not a good trade. So let's look at the same volatility percentile rankings. The lowest volatility trade was 19.16. Now, as of 10/29/20, volatility made it to 64. But the highest was 125.07. The 90th percentile was 70.68. The 75th was 57.20. And the 50th percentile was 40.59. So just take a little look at that. Give your, let your mind look at those for a few minutes. And let's go to something very interesting that happened. So the 10%, the lowest it's ever traded in the 3 years ending October 12, 2020 was 19.16. All right. Well, guess what? Someone did that. They sold, they had a money management firm. We won't mention the name of the firm, but a money management firm, they had hundreds of clients. They sold lots of natural gas options at low volatilities, near the first percentile, second, third percentile. September 2018, natural gas implied volatility at the lowest on record. It was in the first percentile. 99% of the time, volatility is higher than that level. Probability and statistics favored trading from the long premium side. Even the move to more normal volatility levels brought a nice gain in natural gas options. but we had an upside explosion. Longs did well. Anyone short got a lot of their net worth carved out. Let's look at the impact. All right, so this chart, again, has a lot of data on it, but it's a case study. So we're going to start it in November. Volatility had already crept up to 40. It had doubled, all right? Natural gas futures had made it to 324. The 350 natural gas call in premium, and then the 350 natural gas call in dollar terms. We're not going to look at the $4 calls in premium or dollar terms. So let's just shift ahead a week, all right? Basically, let's go to Friday, November 9th, a little bit more than a week, all right? Natural gas is now up to 372, all right? And volatility is now up to 52.47. Remember, this firm and a lot of people sold volatility below 20%. And it's now at more than double that, all right? So the natural gas has gone from 1481, 0.1481 to 0.3927. Look at it a week later now, Friday, November 16th. The option's gone from 0.1481 to 0.9257. Volatility has gone up to 98%. It's almost 4 or 5 times the level as it was from the lows. Let's look a week later. Well, a couple days later, volatility is at 125%. The option is trading at 1.3095. Look at the dollar terms. It's gone from $1,481 to $13,000. Imagine selling short a couple hundred call options at $1,481, and they're worth $13,000. In fairness, you'd have gotten a margin call long before this, which is exactly what happened to a couple of firms that sold these things. They got margin calls, some of them massive, and the losses were pretty darn big. So this is a perfect exercise of what happens when you don't pay attention to the impact of volatility. You just have to do it. And it's homework you got to do. If you're selling low volatility, statistically speaking, it's going to be very hard for you to make money. If you're buying volatility in the 90th, 95th percentile, you'll make money sometimes, but most of the time volatility is going to go lower and you're going to have one heck of a headwind. And as any airline pilot will tell you, you don't want headwinds. You use more fuel and it takes longer to get to your destination. You don't want this to happen to you. So we will, we're at 4:20 now. We want to leave some time for Q&A. So our hosts should be chiming in here any minute.
Yeah, that was great. Great presentation there, Dave. Now there was a question here that came up when you were talking about the CL prices and specifically about the negative, that day when the CL went negative. So the question is, how did the market work with prices below zero for that particular front month contract?
Surprisingly, it worked very well because we were prepared. A couple of our larger users came to our clearinghouse and said, you might want to consider preparing for negative pricing. And when I heard this in a meeting, I thought, what? I mean, nothing can go below zero. And it's like, well, if you know economics, sometimes there's so much of something in the world that no one's going to pay anything for it. They're actually going to pay you to transport it away. You have transportation costs, and that's where some of this came in here. You'd have to store the stuff. But if you had storage tankers, you would have cleaned up. But how many of us have storage tankers, big, 500,000 gallon, very large scale, oil tankers? We don't typically have that. You need a lot of money to fill them up too and store them. So the clearinghouse and the CME talked to many, many users, and they agreed it could happen. So we prepared the clearinghouse and all our computer systems and everything for negative crude oil, and it happened. Fortunately, it only was around for about a day, but the market functioned. It did exactly what it was supposed to do. There were people that were willing to give oil away for free and then pay you to transport it, basically, which is really what it amounted to. Fortunately, it didn't last very long. And it goes to show you, when you flood the market with oil, as the Saudis and the Russians did, and you have a major pandemic, which was, basically a depression for a couple of months, the whole worldwide economy was shut down, you could have negative pricing. And that's exactly what we had. I think, I work for the exchange, but they did a great job. A lot of our users said we did a great job. We warned people that this could happen. We warned them repeatedly. Okay.
Yeah, there's actually not that many questions here. Perhaps one thing that people might want to know about the well, both natural gas and crude oil is how do they settle? So is this a cash settled product or physically delivered? So what do they need to be
They're
aware
both,
of?
yeah. Crude oil is physically delivered, so you'll actually get 1,000 barrels if you want it. The problem is most firms, won't let an active trader go anywhere near delivery. You don't want delivery. You don't want first notice day. Most active traders don't know what's going on at the Cushing oil terminal in Cushing, Oklahoma. And you don't want that. If you're a trader, you don't want the oil. ExxonMobil or, Valero Energy, a refiner, they want the oil sometimes. They'll take delivery. But they are physically settled. All right. So you'll get every day they'll settle to, mark-to-market settlement. But and then they'll collect variation margins. But the actual final settlement, yeah, you'll get it converges to the cash crude oil market, and you will get 1,000 barrels of oil if you want. But you have to go through, you have to have an account set up for delivery. It's a lengthy process. Like I said, Royal Dutch Shell Petroleum and ExxonMobil, know how to do that kind of thing. Your typical active trader, it has no interest. And a lot of the firms have no interest in letting traders take an oil position all the way to expiration. Make sense?
Yeah, makes a lot of sense.
Yeah. Does Tradovate, do you, if they wanted to take delivery of crude, do you have the mechanisms in place?
No, we do not. So they have to be out before the first notice. So basically to avoid any risk at all that there would be a situation where the person holding the position would even remotely have the risk of having to physically receive delivery or I guess like retender the contract. Anything like that we want to avoid. So yeah, not possible with Tradovate, which is, like you said, for retail traders is basically a positive because it just causes more hassle.
Oh yeah, it's a definite positive. You don't, there's really an active trader that trades and speculates and, does technical analysis stuff. No need for him to take delivery of treasury bonds or crude oil or gold. I mean, gold, I can see it, but,
Yeah, and there's a question about
99% of the time, no one's going to want to do that.
Right. Yeah, makes sense. And then, someone asked about when do we close these positions. If I'm not mistaken, it's a day or two before first notice. So ideally, you would roll that position to the next liquid or the next contract month that's liquid before, like a couple days before first notice is what I would suggest you do.
Okay.
One question here. Yeah, well, not really a question, more of a request. We need lower day margins on CL and mini crude. Well, that's really up to, I guess, the volatility will define that, and also just the price of the contract.
Yeah, so someone's complaining margins are a little bit too high.
Right. Yeah.
Tell them to run a clearing firm or a brokerage firm. They'll think totally differently. But given what's happened in the past year, I'm surprised they're not higher, but that's just my personal opinion. Got to remember, the clearinghouse, the Merck Clearinghouse has been around for 200 years. They have weathered every potential crisis you can imagine. And the reason why is that, they should get a Nobel Prize for risk mitigation because they're really good at what they do. You don't run a business for 180 years in some of the most volatile markets in the history of the world. You don't do it by charging low margins. You charge appropriate margins depending on the size of the contract and volatility. Now, there are times when margins are much, much lower. No one calls us up and says, "Oh, thank you for lowering the margins." It's like it's based on risk and contract size. We're not doing it to please any one particular entity in the market.
Right. And like you said, you have a pretty advanced system in place that will calculate these margins on an ongoing basis.
Right. And not only that, you, again, as a firm, Tradovate, you want margins appropriately priced too. And you can change margins. You can never go below the exchange minimum, but you can change more if you want. It's like this one guy was saying, why is Bitcoin margin so high? And it's like, well, because it moves more in a day than the US stock market moves in a year usually. So you need margin. You need the protection of the extra capital.
Yeah, makes a lot of sense. Yeah, that's basically all the questions I can see flowing through here. So I think you answered everything in the presentation. It was all very transparent, very clear. So it was great. I think it was useful. And like you said before, it is recorded, so you could always re-watch this and go through those slides. And if things were not completely clear during the presentation, you can just go back and pause those slides and take a closer look at those.
Yep.
Okay. Well, thanks, Dave and John. Thank you so much for doing this. This was very useful and insightful. And yeah, hopefully we'll be in touch again to do something like this again in the future.
Sure. If you wanted to continue the options and get more into the options, we can do that at some point in the future, because I had to cut it. 62 slides is too much for an hour, and I knew it, and I didn't want to rush through it. I'd rather spend time on that case study than rush through the quick strike stuff. But we can do that again if you folks are interested.
Sounds good. Yep, I'll definitely bring that up. Okay. Well, thanks again. I appreciate it. And everyone, thanks for joining us. And everyone have a great night. And hopefully we'll be in touch again soon.
Thank you.
All right. Bye-bye.